Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known by many of you as Mr. Valuation. Yesterday, or my most recent video, I should say, I covered Walgreens, which is really kind of listed as a retailer, but yet their big competitor is CVS, and I think of them as CVS. And CVS, though, is much more, as you'll see, as a healthcare services company. Okay, but they both have a lot of similarities. And I mentioned I had a small position in Walgreens, and I liked it for the current dividend yield and the turnaround potential of the company, which is happening. In CVS, I like more for its capital appreciation and growth. And I'll get into covering why I don't like their dividend quite as much as I do Walgreens Boots Alliance, although I think that's going to change, and I'll give you my reasons why I believe that. So let's go ahead and turn to FastGraphs, the fundamentals analyzer software tool here. And let's go ahead and look at CVS Health. And I'm going to start out with operating earnings. As I've been trying to do in these recent videos, I'm looking at kind of a 15-point metric approach that I use to try to determine whether I think a stock is research worthy or not. And the first thing I like to look at is earnings growth. And I go to adjusted operating earnings because adjusted operating earnings really tell you how the business is doing. And so I've got a plotting here of the company's adjusted operating earnings going back, roughly 20 years. All right. The second thing I'm looking at in relation to this is valuation. The orange line would represent fair value. The blue line would represent typical market value. And in this case, over the long run here, they pretty much are merged. But the point is, I'm looking for the price line to be below the orange line to give me an indication of fair value plus a margin of safety. Now, in my opinion, CVS meets that goal very nicely when I look at earnings, operating earnings, but I'll also look at GAAP earnings. Now, GAAP earnings, the company doesn't look quite as undervalued, but GAAP earnings do include a lot of accounting convention, and you can see a complete elimination of GAAP earnings here when they made their Aetna acquisition, which was a major deal for the company, and that's something I'll be talking about more as I kind of go through this. All right, but so I look at both of these earnings metrics. Now, I do want you to notice I get a blended PE of 14.48 when I use GAAP earnings. When I use adjusted operating earnings, I'm getting a blended PE of 11 and an earnings yield of 8.5. This just tells me this is closer to cash flows, which are kind of important. But it's adjusted operating earnings, how the business itself is operating without taking a lot of accounting adjustments. Okay, then I'm also looking at the dividend growth trend. Now, this is one negative that I see. The white line on this graph is the dividend. Now, I can clearly see just by looking at the graphic here that the company grew their dividend very nicely for years here. They had a flat period back in 01 to 05, and then they raised their dividend real nice. Then they made the big Aetna acquisition, and the dividend, they've continued to pay it, but it's been frozen. So their dividend record is good, but not great. I like to see consistent, steady increases in dividends. They've frozen their dividend at $2 since 2017. Good dividend. The yield right now is 2.24%. That's good, but not great. But the bottom line is I would like to see more growth in the dividend, if you will. The next thing I like to look at is reasonable of return expectation. I want to talk about that in a little detail. That would be number 4 on my list. Now, I can do it right here in the historical graph and just point to what the stock would be worth if it traded at its reasonable 15 PE ratio, which would, be a PE ratio expansion on top of some growth. But I can also do that going into the forecasting calculators that FastGraphs offers. And in the case of CVS, we have 24 analysts that are giving estimates for this year and next. And of course, this year ends, in December, and next year ends in the following December. And so if I was trading at a 15 PE ratio, then I would look at some very strong returns, going all the way out to even to 2023, where I drop down to 16 analysts. I'm evaluating what I'm looking at, ladies and gentlemen, as I go through this. I want to make that point. I have a 21% plus. Now, the average estimates are calculating out at about 7.25%. Now, I also want to point some other things out about analyst estimates. At the bottom of the graph here, you see the trend. Analysts 6 months ago were looking at 764 for this year, then 775, then it went to 777, which is what we're currently looking at now. Now, yesterday, the company just announced that they're going to be, or they just actually raised their guidance, and they raised it to about $7.90 to $8. So I can go into the custom calculator here, All right, and I can click the estimates tab for those of you who are subscribers. And instead of 777, I'm going to put 7.95, which is kind of between the $7 to $8 guidance that the company has guided. And I want you to note it hasn't changed anything really all that much. Okay, but it is a little bit higher. But the point is, I like the trend. The estimates are going up. Now, a lot of you have, made comments about how inaccurate the analysts have been. Well, when you're looking at CVS, the scorecard on this company has been excellent. And I think you can attribute that to the company giving good guidance. But the analysts have been right on CVS, virtually 100% of the time. And on a 1-year estimate with a 10% margin of error, when they were making an estimate 1 year in advance of where we currently sit, they were right 92% of the time, and the other 8% of the time, the company beat the estimates. And you can see that listed here. There's really only one beat. In terms of 2-year forward estimates with a little, more gracious margin of safety, they've been 100% met the analysts' expectations. So the analysts have done a pretty good job here. But I want to make another point. Ben Graham often talked about utilizing historical earnings growth in lieu of, estimates as an estimate proxy. He'd like to say the 5-year average. If you go to the Fast Graphs Historical Compound Annual Growth tab, you get a pop-up here. And this pop-up gives you a history of the growth rates, not using any estimate data here. This is only historical growth. So in 20 years, the company grew earnings at 11%, over 19 years, 12%. And you can see double-digit growth, all the way through even the 10th, 9th, 8th year, 7th year, we're still close. More recently, though, 6th year, we got 893 and, in the 6 and 7. That's consistent with the number that the analysts are currently forecasting. Now, I go back to the historical fast graphs here, and I'm going to run this as a 5-year graph. Now, let me be clear. I'm going to do 7 years because I'm eliminating, I'm going to include some estimate data here. So I'm going to run this as essentially a 5-year graph. I get about 6%. If I completely take out the estimates and add, a couple of years here, then I'm getting 6.81%. So the point is that a forecast of 7.25% could be a little high. So if I use the historical growth calculator, if I wanted to be more conservative, I could pick the 6.5% number, and I still get very attractive. In fact, it doesn't change very much. I still get over a 20% annualized rate of return, assuming the company moved back into alignment with its fair value. Now, if I look at the historical graph here and run it from a longer time frame, you get a better perspective. You can see that it's generally moving in that direction. Now, I do want to do, for disclosure, I do want to point out that I own this stock with a $56 cost basis. It's actually $56.55. So this was May 3rd. We have weekly closing prices here. This is $56.66. That's within a dime of, what, our cost basis is. And you can see the company has been averaging an annualized rate of return of 23%. It's already increased by over 60, or just right at 60% over this couple of year time frame here, as it's reverting back towards that 15 PE. All right, so if it gets all the way back, like I showed you earlier, then you really have a opportunity here to make a real nice investment. The only dish that I have on the company right now is the fact that they haven't been raising their dividend. But keep in mind that their dividend hasn't increased because of I believe because of the Aetna acquisition. Okay, now talking about the dividend, let's go look at free cash flow and dividend coverage. Now here I'm not really so much concerned about the price. What I'm concerned about is the company generating free cash flow that covers the dividend. And you can see the company's dividend payout ratio of free cash flow is about 30%. There's a lot of room to pay the dividend, reduce debt, which is another issue with this company a little bit. So I feel very good about the financial. Then I can also go look at operating cash flow and look at it from that same perspective. Is it covering the dividend? And again, the operating cash flow payout ratio is even lower, which makes sense, at around 20%. So I've got plenty of cash flow covering the debt. So, everywhere I measure this company now, even if I measure it at price to cash flow, it looks attractive. If I measure it price to sales, the company looks attractive. So I do consider this a very inexpensive stock. And I've used fast graphs here to, cover all the various aspects that I cover in my 7 points. I look for earnings growth, valuation, dividend growth trend if the company pays one. This one does. Reasonable return expectations, the forecasting calculators. I look for an investment grade credit rating of BBB minus or better. This company is BBB, so it's one notch better than that. And then, of course, I look at free cash flow and cash from operations covering the dividend. So from there, I will move on to fund graphs. Now, we're not quite ready with the new version of fast graphs for the fund graphs, so I'm going to go ahead and use the older version here. And in fund graphs, the first thing I like to look at is I want to see cash flow from operations. Okay, so I go into my cash flow from operations, look at, or operating cash flow, the same thing. That's the royal blue, and I want to see it higher than net income. All right, so I want to see the company bringing their cash flow, bringing some profit to the bottom line, if you will. And there's a real nice, they're definitely generating some profits. Now, there was a dearth of net income in 2017 period through 2019 here, strictly because, again, the company made the Aetna acquisition, and I'll cover more of that a little bit later. From a standpoint of sales trend, you can see that the revenue growth here has been extraordinary. The company's revenue has been growing dramatically, over this time frame. And if I shorten this time frame, you can see, just even looking at it from a standpoint of more recently, they've been growing revenue at about 11% a year. So that's obviously a big plus as far as I'm concerned. So, the 3 to 5 year minimum trend line is real good. The longer term trend line is good. Now, I also like to look at their debt to equity ratio and, get into some of these ratios here because I prefer a 1-to-1 in terms of, or industry norms, but this company has taken on a lot of debt as a result of that Aetna acquisition, but you can see they've begun to amortize their debt. They've been reducing their debt. This is long-term debt to equity ratio. So their long-term debt to equity ratio has been dropping, which that's a plus, but it's a little bit of a negative at the same time until they get that, under control. The next thing I want to look at is gross and net profit margins. Once again, they had almost no net profit margin during the Aetna acquisition, which happened in 2018, but they're beginning to earn some net profit again. This company does have a big retail operation, so their net margins are not that strong. They're single-digit net margins, but they do bring, money to the bottom line. But they do have rather nice gross margins at about 18% or so. Now, return on assets, the company's a little bit light from what I like to see, but relative to industry norms, they're probably typical for a company that has as big a retail operation as they do. And then return on equity is a little better, but still a little light of what I'd like to see. But again, that's typical for companies in this particular sector. So as I go through all of this with CVS, I like the consistency of their revenue growth. I like the consistency of their adjusted operating growth. I like the fact that they've been a double-digit grower. They're kind of going through a transition. So I'm only making my investment forecast on a 6 or 7%, growth expectation. I'm not looking for double-digit numbers, but if I got double-digit numbers, it would even be better, obviously. So, I really like this company. I think it's very inexpensive, and I do have a rather large position, as I've mentioned. Now, some things I don't quite have on the graphs yet, but I will be getting some updates on some of the numbers that have just come in. The company reported earnings yesterday. They beat earnings on their non-GAAP, or the operating earnings beat. They ended up with $1.97, which beat by 18 cents. Their GAAP earnings of $1.20 missed by 20 cents, but again, there's some accounting convention involved in there. Their adjusted earnings guidance of $7.90 to $8 has, risen from $7.70 to $7.80, and the consensus analyst was $7.79 here recently. So, we're showing $7.77 currently. That number is going to increase to about $7.90, $7.95 here as soon as the data gets loaded. So, but it doesn't really change very much. But the point is, they had a good quarter. All right, now the company's results were very good. They traded kind of flat yesterday when they reported earnings, but they're up about 4.4% today. So I think investors might be starting to see the benefit and the margin of safety that this company offers. There were some issues. Their medical benefit ratio increased to about 85% from 70%. That's the percentage of benefits they pay relative to the premiums they charge, but that's also typical for this industry, so that doesn't bother me very much. I think all in all, the company had a really good quarter. The company's really positioned extremely well for the healthcare environment as we're going forward. After they made the Aetna acquisition, they have 4 reportable segments, according to Zacks. They have pharmacy services, retail, and long-term care. They classify as one sector. They have healthcare benefits, which of course relates to Aetna, and then they have some other, which I'm sure has to do with the retail sales, et cetera. Bottom line is, I really like this company. I think it's very attractively valued. I think it's a good opportunity. I do believe the dividend will begin growing again once they kind of fully digest the Aetna acquisition, and assuming that their cash flows continue to go up and grow, which I'm expecting that to happen. Their operating cash flows are already being forecast, to start improving in future years. They're just not getting any dividend estimates here, but, modestly for the next couple of years. But again, the company is extremely solid. The balance sheet is good and it's improving. Not great, but good, and it's improving. So all in all, I like CVS Health. Anyway, I want to thank you all for watching the video. I hope you enjoyed it. I like it better than Walgreens for a total return investment. But on the other hand, I really like Walgreens for a turnaround, current income, higher yielding investment with a little bit dividend growth. Investments should be made according to your goals, needs, objectives, risk tolerances, et cetera. But they should always be made with a reasonable expectation of what the company might be capable of generating for you. Okay, there's no such thing as one size fits all in investing. It's been Chuck Carville saying thanks for watching. If you like the video, give me a thumbs up, ring the bell, subscribe to the channel if you haven't already, and you might want to take a close look at Fast Graphs, the fundamentals analyzer research tool. I wouldn't even imagine investing in stocks without it. Thanks for watching.